Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Why is it important? Well, the vega is going to impact your options profitability, especially if I buy longer dated options. So the at-the-money option is going to have the highest vega. And you see that as we move out in strike price, the vega actually is significantly reduced. There's a great site, and I'd urge you all to go to the site. It's called Live Vol. They have some free services, and they also have some paid services. This is actually a paid service, but they do have some free stuff. Before you get into any options transaction, you want to really know where the vol, where it is today and where it was. And if you'll notice, taking a look at slide 51, the red line is the implied volatility. That means what is the market expecting in the future? And that's in the top pane. And the blue line is the historic, or what did the exchange rate actually do? You'll notice that we saw volatility that was significantly higher last spring, and now we saw just recently a very, very low volatility. Some of my friends that really follow the FX market, they've told me that the correlation between the U.S. dollar and the Canadian dollar has been very, 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 very tight, meaning if the correlation between one and another, they're not moving that much, by definition, that means lower volatility. So the U.S. dollar against the Canadian has been moving pretty much lockstep. And look at the chart below. We've seen almost no movement since July, basically flat line. So if you had predicted it or looked at an option strategy that was looking for lower volatility since last July, you'd have done well. If you would have done, let's say, a straddle or a strangle anytime from July through today, you'd have done really poorly because the U.S. dollar Canadian has actually been moving in lockstep. Does that mean it's going to move in lockstep forever? No. In fact, that's what we, as traders, that's what we're looking for, the edge, when these correlations might break or they might change. But recently, U.S. dollar Canadian, pretty much alike. So vega by duration. We see much higher vegas as we move out in time. So if I was only concerned with vega, I might buy short-dated options. Problem with short-dated options is that I'm getting more theta. So you sort of get my point. You got to understand that the Greeks, there's some risk in all the Greeks, whether it's the delta, whether it's the gamma, whether it's the theta, whether it's the vega or the rho. But I'm hoping that I illustrated all these points so that at the end of the presentation, and again, please, you can go back to fxoptions.com, check out the archive, listen to it again and again, and hopefully you'll understand more about the option Greeks. Love this. Absolutely love Live Vol. Not seen this really in any place except in big investment banks that you can get the turn structure. So if you're interested in volatility, go to Live Vol, sign up. I believe it's $100 a month to get this kind of chart, which is it's really amazing. What it's telling me, it's called vol skew. And volatility skew, what that says is that volatility is probably going to be different over different strike prices. Not only different strike prices, but different months. If you take a look at that graph there on slide 53, the red is the shortest dated options, followed by the yellow, the second month, then green, then blue, and then dark blue and purple. And you also notice a positive skew. What does that mean? Well, I am planning on giving another back to basics on skew, but what it's saying, some would say that it's predicting that the U.S. dollar is going to rally against the Canadian dollar. I might not actually agree with that statement. What I might say is that if the options market is predicting that if the U.S. dollar was to rally against the Canadian, that the variance or the changes per day might be much greater. And think about what happened in 2007 and 2008 when the U.S. dollar went from parity up to $1.26. They were very, very volatile days. So that's the way I interpret this chart, is that the options market is saying that the higher strike prices might actually become more valuable if the asset's picking up, not only because of the exchange rate going to those strike prices, but because the underlying exchange rate might get more volatile as the asset moves from, let's say, 104, where it is today, to 115 or 120. That's what you'll notice that this upward sloping. I don't have it in this PowerPoint presentation, but if you look at U.S. dollar yen, it's the reverse. So that it's going to actually look sort of like this, meaning that the options market thinks that the dollar weakens any more than it is, the dollar-yen variance will be higher. But if you're interested in this kind of stuff, which I'm sure some of you are, go and check out www.livevol.com. And I think they have a trial, and this is the paid version, but again, go and check it out. Interest rates are important for the interest rate differential. This is U.S. rates from 1982. When I first got in this business, Fed funds was as high as 19%. Now we're zero. So I can sort of unequivocally predict that we will see higher rates sometime in the future, that rates will not stay at zero forever. I just don't know how long, and that, of course, is not a great prediction. It's the U.S. dollar against the Canadian. Over the last 10 years, we've seen a significant reduction in Canadian rates. And this is where we were as of a couple weeks ago. Highest rate, the ones that I was monitoring, Australian dollar. Of course, the Brazilian real would probably be higher than that, but I didn't monitor that at the time. So I look at the Australian each day AUM because I want to know, since that's the highest interest rate, some traders actually use that as their carry trade. I want to know what the AUM is doing. And again, that's the highest interest rate. So the interest rate differential, that helps measure the difference between, if we know there's a carry trade going on between, let's say, the Aussie and the U.S., well, option traders are going to know that there is no free money involved, even though in the media they talk about this carry trade. Well, there's risk involved with that. How the option traders mitigate that risk? They might actually look to buy put options to protect themselves from an Australian rate devaluation, and so they buy put options. So you might want to look at that. If you look at the AUM puts relative to the calls, they're going to be higher because of the interest rate differential.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.